Hello to everyone. Today I am here with Finance for Non-Finance Professionals Part-6 on my channel, Financial Reality. If you want to develop the understanding of concept, please do review my video till end. Secondly, if you are interested to have update videos on banking and finance related topics, please do subscribe my channel. Here we are going to discuss time value of money concept. It's very important concept that is used by every person who have any type of the investment in their daily life. First of all, future value by applying simple interest method. Thereafter, future value by applying compound interest method. You should know about it. And next one is present value by applying discounting method. Time value of money. What do you mean by time value of money? Money received today carries more value than the same amount received in future. Means you have invested the money. Definitely, on its maturity, you will receive more money that you have invested today. Why money received today carries more value than its in the future? If you purchase a pen today for value 100, the value of safe pen may be increased to a value 115 in future after 1 year. It means the value of asset increased by 15% over a year time, and the value of currency is depreciated. The increase in price of product is called inflation. We used to see the prices are day by day increasing. It means the inflation is going to be increased. To keep the value of the currency at par means if you have 100 rupees, so with the inflation, you want your money value should also increase. The central bank of your country adjust the interest rate as the part of monetary policy. The countries having higher inflation, in those countries you will find high rate of return. The countries having less inflation, in those countries you will find lower rate of return. It is only because to keep your investment at par. Change in the value based on two factors. One is the time and other is the appreciation and depreciation rate. If the inflation is negative, so interest rate may be equal to 0%. Example, Mr. X invests 600,000 in 5 years maturity financial asset. It can be term deposit, it can be bond. And its expected rate of return is 19%. Calculate its maturity value by applying simple interest and compound interest method. First of all, you should know what is the difference between the simple interest and the compound interest. So we are going to solve this question by first applying simple interest for your understanding. Thereafter, we will solve the same question by applying compound interest. What is given in the question? Investment value at time 0. 0 time is the time of investment. That is 600,000. Maturity period is 5 years. It is also called redemption period. Rate of return is 19%. So the initial interest investment is representing by PV0. 0 is the time of investment. And term is representing by N, that is 5 years. Rate of excuse me. Rate of return is rate of return is representing by K, that is 19%. We have to find the maturity value, that is future value N is 5. First of all, we are going to calculate by applying the simple interest. Here, future value equal to PV naught plus PV naught multiplied by period, that is 5 years, and rate, that is 19%. Formula comes to PV multiplied by 1 plus N multiplied by K. So it comes after 5 years, if you are applying the simple interest, the value comes to 1,170,000. It's the answer by applying simple interest. In case of compound interest means every year the interest will add back. For example, after first year, your value comes to 6 lakh plus 19% of 6 lakh. Value is Y. Now for the second year, you will again apply the interest rate. Now for the third year, again you will apply the interest rate on the value of the balance of previous years, principal plus interest. So I am not going in depth. I am directly applying the formula for the compounding interest, that is future value N, that is 5 years, present value multiplied by 1 plus K power N. So it comes 1,431,812.20. So normally in our financial sector, we are using compound interest method. We will also solve these calculations on Excel for further simplicity at the end of this course. Present value of the discounting. Here, a builder offer a flat against the agreement to pay 7 million after 3 years. Give your comment, either you should opt for the agreement or not. If the expected rate of return is 18% and the present value of similar flat is for 5 million and 500,000. It's the present value of the flat. But he is asking you, by having the agreement, that you have to pay 7 million after 3 years. Now the same formula, from the same formula, you have the value for the present value, that is PV naught is equal to FVN divided by 1 plus K power N. So it comes 4,260,499. So in this case, you are paying less. What is the present value of the flat today? So it is considered to be a favorable offer for you because your present value of your investment is lower than what the actual price of flat today. Thank you very much. See you with the upcoming video on finance for non-finance professions with more and more relevant topics.